Imagine this. The stock market rises for months. Everyone talks about quick money. Investors are euphoric. This is the bull market. A few months later, panic, red numbers, crash sentiment. Welcome to the bear market. But what exactly do these terms mean? In this video, we look at what a bull market and a bear market are, how these phases arise, and concrete tips on how to behave correctly in every market phase. So stay tuned, because those who understand the market make better decisions. A bull market describes a phase on the stock market in which prices rise over a longer period of time. At least 20% return on investment, often within a few months or years, is typical. Why is it called a bull market? It's simple. The bull attacks from the bottom up with his horns, symbolizing rising prices. A bull market is characterized by optimism, growth expectations, increasing corporate profits, low interest rates, and positive economic data. During this phase, many people, often beginners, invest. The prices seem to rise effortlessly. A famous example, the bull market after the 2008 financial crisis, which lasted almost 11 years, until the 2020 corona crisis. The bear market is the exact opposite. Here, prices fall over a longer period, usually by 20% or more. The name also comes from the animal. The bear strikes with its paw from top to bottom, symbolizing falling prices. A bear market is characterized by pessimism, declining profits, economic uncertainty, high inflation or rising interest rates, and selling out of panic. The market sentiment is turning. Investors are pulling their money out, selling out of fear, and that accelerates the downward trend. A well-known example, the corona crash in March 2020, when many markets collapsed within a few weeks. Both market phases are created by a combination of economic development, monetary policy of central banks, corporate profits, inflation and interest rate policy, and most crucially, psychology. A bull market usually starts quietly, with solid fundamentals, a good mood, and favorable entry opportunities. It grows through trust, investments, and media reports. More and more people are getting involved out of FOMO, fear of missing out. A bear market often begins with a shock. Interest rates suddenly rise. Corporate profits are declining, or political crises and pandemics. Then the mood turns. Many sell out of fear, which pulls the market further down. Interesting, many investors only recognize the beginning or end of a bull or bear market in retrospect. The stock market is not just about numbers and facts. It is also a game of emotions. In a bull market, the following prevail: euphoria, overconfidence, greed, and the thought, it can only go up. Many investors buy blindly without analysis, just to be part of it. This can become dangerous, especially at the peak of the bubble. In a bear market, however, the dominant factor is fear, pessimism, panic, and the feeling, I have to sell everything before it gets even worse. The result, people sell in the downswing, even though they bought in the upswing. Emotions lead to poor decisions. Of course, no one can predict the future, but there are indications that suggest an impending change, possible start of a bear market, overvalued stocks, high P ratios, interest rate hikes by central banks, exaggerated euphoria, and the first signs of economic weakness. Possible start of a bull market, prices stabilize after crash, positive early indicators in the economy, more investment from professionals, and good company numbers. Technical analysis, such as trend lines or moving averages, can also be helpful, but it is never decisive on its own. The most important rule: emotions out, strategy in. In a bull market, don't buy blindly, quality over hype. Secure profits, and maintain diversification. In a bear market, No panic selling. Examine opportunities. There are often real bargains now. Maintain long-term strategy. And buy back ETFs or quality stocks. Successful investors think in decades, not days. Whether bull market or bear market, both phases are part of the stock market like ebb and flow are part of the sea. It is important that you do not try to guess the perfect time, but remain wise and calm. Those who understand how markets tick remain calmer and make better decisions. Now I'm interested in your opinion. Backhand index pointing, right? What has been the most exciting stock market phase for you so far? Or have you ever experienced ups and downs? Write it in the comments. I'll be reading. And if you liked the video, like it, subscribe to the channel, and share it with friends who are also interested in the stock market. Thanks for watching. See you next time.